Welcome to 50 Scales of Gray. I'm attorney Michael Bender, co-founder of the Gray Legal Group, your family law firm where we help business owners and professionals survive divorce with their money in their pocket and their kids by their sides. For the next 30 minutes, we're going to dive into the exciting world of California family law issues. Now, of course, the views I and my guests express during the show are ours only and are only given for informational purposes and not legal advice. If you have a family law case, I highly advise you talk with an attorney one-on-one about your individual legal situation. On today's show, we'll be reviewing divorce and taxes. Yes, the old saying in life is the only things that are guaranteed in life are death and taxes. But today, it's divorce and taxes. What you need to look out for when you're going through a divorce and how it affects the taxes that you pay. I'll be joined today by Pietro Canestrelli of the law offices of Pietro Canestrelli, a tax controversy boutique located here in Temecula. We'll be discussing the importance of using a tax specialist and how taxes come into play on family law cases. But first, why am I so excited about talking about taxes? Well, it's because taxes are so important when it comes to family law cases. Most people just think of taxes on April 15th. Maybe when they look at their paycheck and see the government's taking such a big cut. But in reality, taxes need to be front of mind for everyone, especially in a divorce or child custody or support case. First, let me say I am not here to provide tax advice. This is not about minimizing your taxes, how to cheat the system, not pay taxes. It's about how taxes and divorce or family law cases relate. Always, always, always consult with your tax professional, CPA, or attorney before taking any tax strategy or action. Now, taxes and family law, these two interplay basically in two aspects. One, the division of tax obligations, usually in the form of back taxes, and two, calculation of support to be paid from one party to the other. In the first scenario, division of tax obligations, or even the division of a tax refund that occurred prior to the parties' separation, is a community obligation or community property. We talked last week about the community properties, so you know that each spouse has an equal interest in what is earned during the marriage. The same goes for community debt. If it was incurred during the marriage, i.e. taxes, both parties are equally responsible for it. Now, this doesn't take into consideration if the parties separated any other day other than December 31st, meaning that when we look at back taxes to be paid or the refund, there may be just a portion for an individual tax year that needs to be divided. Again, consult with your tax professional and family law attorney to determine what that amount is. Now, taxes and support issues, these interplay when we get down to the disposable income. That means how much money somebody actually has to pay support. There's a long, and I mean long, formula that this state uses when calculating what is called guideline child support. It takes into consideration various tax brackets, tax amounts on non-traditional income, and so forth, that get down to the nitty-gritty of what a parent actually has at their disposal to pay in child support. Now, for spousal support, the court has leeway to determine what is appropriate to pay based on various tax consequences and scenarios. But more on that later with our guest. As you can see, taxes bring a unique aspect to a family law case. They must be addressed in a way that the court fully understands the consequences they have on incomes as well as community property. Again, you should always consult with a tax professional to fully understand how your situation plays out in a divorce. For more information on this and other family law issues, visit 50scalesofgray.com. That's Gray with an E, 50scalesofgray.com. When we come back, we'll welcome our guest, attorney Pietro Canestrelli, who will discuss with us in detail family law and taxes. We'll be right back. Welcome back to 50 Scales of Gray. I'm attorney Michael Bender, co-founder of the Gray Legal Group. And it's time to welcome our guest today, attorney Pietro Canestrelli, founder of the law offices of Pietro Canestrelli, a tax controversy boutique. Pietro, welcome to the show.
Thank you for having me, Michael.
Hey, Pietro, before we dive into the fascinating world of taxes, if you could introduce yourself to our listeners, tell us about your background and how you know the intimate details of what the IRS and the FTB is doing in their tax world.
Well, I've been a tax attorney, and I emphasize tax attorney, for 23 years now. I spent the first 6 years of my career working for the IRS as a tax attorney in Washington, D.C. Since then, I've been in private practice working for taxpayers and not for the IRS. I am what is called a certified tax specialist with the California Bar. I also have a advanced degree in tax law. Most attorneys have what is called a Juris Doctorate. I have that, plus I have what is called a Master of Tax Law. And 23 years of experience. This is kind of what I've done my entire career.
Fantastic. That's quite a history. Definitely gives a great background to help the taxpayer fight the tax collector. Let's get to some questions about taxes and why it is so important to have somebody like you in their corner. First, everybody just thinks, oh, taxes, I have to deal with them on April 15th or whenever they decide to file. But first off, what is a certified tax specialist and why should they work with one?
Well, there are hundreds of thousands of California attorneys, but about 1 in 1,000 are actually tax certified specialists. You have to have the background, you have to have the proper education, and lastly, you have to actually take an exam that's administrated only once every 2 years, and you have to pass that exam. And then once you have all that, then you are designated from the California Bar as a certified tax specialist, which means that you are a specialist in this particular area of law, and it's kind of the highest designation that the California Bar can give someone.
Fantastic. So, as a certified tax specialist, what types of taxpayers can you help?
We can help a lot of different taxpayers, meaning we help individuals, we help businesses, we help people that are dealing with income taxes, and that would be the IRS and the California Franchise Tax Board. We help people that are dealing with employment taxes, and that again is the IRS and the California Employment Development Department. I always want to say Unemployment Development Department, but I corrected myself.
Every business owner knows about the EDD.
Yes. And we also could help you on sales taxes. Now, there's no national sales, so IRS doesn't do that. But in California, we have a fairly new department, which is called the California Department of Fees and Tax Administration, CDTFA. They used to be the Board of Equalization, the BOE, but they're the guys in charge of taxes. So we could help you if you're under audit or if you're unhappy with what happened at the audit, and we could also help you if you just have an outstanding liability. So unlike most resolution outfits, we could help you at every stage of the tax controversy process.
Key word there that you use, tax controversy. Can you explain a little bit what you mean with the term controversy?
If you file your taxes and you file your tax returns, that is what we call compliance. Filing returns, that is the normal business thing. When the IRS or the FTB or any of these other taxing authorities contact you for an audit, that's called controversy. Or if they take money out of your account, they garnish your wages, they file a lien against you, that is all in the controversy realm. CPAs and EAs and other people do your returns. We come in when there is a problem.
So compliance is that typical thing that the standard taxpayer thinks of when, I have to do and pay my taxes.
And as miserable that is, a audit or collection activity is even more miserable.
Now you mentioned tax resolution. You use the word resolution. What is the difference between your firm and other tax resolution businesses, services?
For one thing, we have a broader range of services. We could help you with that audit. We could go into U.S. tax court. We could go into federal district court. We're not just limited to what is called tax collection, meaning you owe a certain amount and you're trying to get it resolved. The other thing is we are attorneys. And we are the highest level of people who could represent you in front of the IRS. It really goes down to EAs and then CPAs and then attorneys kind of at the top. So we have the knowledge that these other places where you're probably dealing with EAs, enrolled agents, and not attorneys. Lastly, we actually care about our clients more than these places do, and we have a lot of former clients of tax resolution businesses that have decided to move over to us. I wish I could say another difference is we charge a lot more than they do, but we honestly do not. We actually probably on average charge a little bit less than most tax resolution businesses.
Fantastic. All right. A lot of people out there don't know how the IRS works.
Mm-hmm.
You hear sometimes some celebrities. I'm going to think back, maybe it was the early 90s. Somebody was thrown in jail for tax evasion.
Mm-hmm.
Is the IRS going to throw me in jail or take away my house if I don't pay taxes?
The short answer is there is a very slim possibility that they may do this, but it's so small that I would say no. And the reason is that it takes very little effort to take money from you. It takes a lot of effort to throw you in jail. So in my 23 years of being a tax attorney, I've helped and met with literally thousands of people who have tax problems, and I could count on one hand the people that may have been a criminal type, may be subject to criminal sanctions. As far as the House is concerned, they changed the rules in 1998 to make it much more difficult to take away your house, to levy your house. And again, I've been doing this for 23 years, and I have yet to have a case or meet someone where the IRS is even beginning the process to take your house away from the taxpayer. So short answer is no on both counts.
So pretty much it's about the money. They're there to enforce the taxes. They want their money when what they think that they're owed. Correct?
It's all about the Benjamins now.
One final question here. Being contacted by the IRS, what are the ways that an agent will contact you? Can they come, knock on the door? Here's my badge. I'm here to collect money. Oh wow, I have this email that says I'm collecting from the IRS. Click here.
Right. So in general, the IRS can only contact you two ways. The vast majority of the time, it's going to be via a letter, correspondence. They don't email you. They don't call you. Those guys are scams, and you should ignore them. Once in a while, okay, they will go and knock on your door. This is usually for a business, but they can knock on individuals' door if you have ignored their string of letters. So you will either get a letter or you will get a knock on the door. Anything else you could ignore. And the IRS actually has a website, an email address that you could report these scams to.
Pietro, somebody gets a letter or they've been ignoring them, they get that knock on the door. How can they reach you?
Well, you could call our office at 951-319-7674, or you could contact us through our website, which is www.ietaxattorney.com. I don't know if people do www anywhere, but it's IE as in Inland Empire, taxattorney.com.
All right, so if you get that letter, you heard it here, ietaxattorney.com. Pietro, that is some great information. Having a tax specialist is so important, and I can see how much help it provides to the taxpayer to navigate the very complex tax code out there and the stressful times when you get those notices. When we return, we'll be continuing our conversation with Pietro about divorce and taxes, something you don't want to miss. We'll be right back. Welcome back to 50 Scales of Gray. I'm your host, attorney Michael Bender, co-founder of the Gray Legal Group, your Southern California family law attorneys, where we fight for business owners and professionals to survive divorce with their money in their pockets and their kids by their sides. I'm joined today by attorney Pietro Canestrelli, owner of the law offices of Pietro Canestrelli, a tax controversy boutique. We just talked about the importance of working with a tax specialist such as Pietro. We now turn to divorce and other family law issues and the impact on tax matters. Pietro, would you agree that taxes can cause wrinkles and issues when going through a family law case?
Certainly. Certainly.
Short and to the point right there. All
Yes.
right. We see taxes coming into play quite often. So I'd like to get your take on a few issues that we commonly see.
Yes.
All right. We have all heard the term innocent spouse. Can you explain what this means? Because in the context of a divorce, husband and wife are fighting.
Right.
Well, he did the taxes. I just never.
Right.
I just signed where I was supposed to sign so we could get our taxes done. I'm going to claim innocent spouse.
Right.
What exactly is an innocent?
Well, it is. Right.
What exactly is an innocent spouse?
All right. For tax purposes, I'm not going
Yes,
to
yes,
talk
tax
about
purposes
but
only,
for
please.
tax purposes, innocent spouse relief is one of the strongest rights that a taxpayer has. It's codified, so it's not at the discretion of the IRS. It really is your right as a taxpayer to request this and to be granted to it if you fall within the test. And basically, to understand innocent spouse, you have to understand how tax returns are filed. And when you're married, you have an option. You could file married filing jointly, where both of you are filing one tax return together, or you could file married filing separately, where you file separate returns. Now, if you file jointly, it doesn't just mean that you get the tax benefit, and it's usually much better to file jointly, of filing jointly. It also means you have the burden of both owing the amount that is on the return. Not only that, if there is an audit and there is an adjustment to the jointly filed return, you both are jointly liable for that assessment that comes out of the audit.
We actually talked about that earlier with regards to community debt. Here in California, we go in front of the court and present, hey, there's a $10,000 back owed tax bill during the marriage.
Right.
They're equally responsible. So I think that's both in the eyes of the IRS as well as the California courts.
Right. So the IRS is not going to say you and your spouse or ex-spouse owe $20,000 to the IRS. The IRS doesn't look at it like, I'm going to collect $10,000 from one spouse and then I'm going to collect $10,000 from the other spouse. They're really looking at it as, and they have the right to collect the full $20,000, meaning they could swipe your bank account and take the full $20,000 and say thank you very much, and they go on their merry way, and you have paid all of the tax debt of you and your ex-spouse. So this was recognized as unfair decades ago. So they made a law that is called innocent spouse. And the basic idea is if one spouse kind of had control over the tax returns, or they had control over, say, a business that the other spouse wasn't part of, and there was an adjustment to that business income, then it seems unfair to have that spouse still liable, jointly liable for that liability. So innocent spouse is a way to sever that joint liability, meaning if both of you are making income and there's adjustment on both of your income, it doesn't do you very much good. But if only one of you is making the income and there is adjustment on that income, then severing joint liability means basically that you don't owe. And
Now when you say
one of the cases examples is last year we had a lady whose husband had a business. She had minimum to do with the business. The FTB said they were jointly liable for over $500,000 of taxes. We got her innocent spouse relief, and because it was the husband's business, she owed nothing.
So really quick, just to differentiate here in the context of family law and the divorce, what you're talking about is here, if you sever that liability in the eyes of the IRS, the IRS will not go after the innocent spouse for payment of that debt.
That is correct.
However, we need to deal with it in...
Not only will they not go on, they don't owe it.
They don't owe it. They
Right.
don't owe it in the context of the IRS. 'Cause I want
Correct.
to. I want to be clear here because we talk about issues of community debt, community property, community debt. So that's going to be something that would also have to be likely litigated within the family court to ensure we're talking, awarding of debts within the context of a divorce.
Right.
The IRS may have said something, doesn't necessarily mean that it's not a community obligation.
That's
so
right.
I just wanted to clarify that real quick.
And the FTB has kind of a different test than the IRS because the FTB is a California entity. They respect of what the California courts say. So if there is a division or if there's something in there that they're both still jointly liable, the FTB is going to respect that.
But that's different than innocent spouse. So it actually kind of dovetails into another
That
question.
is
I had.
innocent spouse at the FTB level.
Oh, interesting. So let's say in a divorce,
Right.
one spouse is awarded the payment of the debt. It's an equalization. It's just this goes in your column. It's community debt, but this spouse A is required to pay it through or after the divorce. Spouse B is not does not have any family court obligation to pay it. The FTB will go ahead and honor that and only go after spouse A.
Unless there's something strange going on, that is what the FTB is looking at.
Wow.
Almost exclusively. IRS is looking at other things.
The IRS is going to be completely different because if you don't go through that innocent spouse, they can still go after both tax debtors at the time.
Right. So FTB is much more likely to respect the property agreement of the ex-spouses.
So in a situation where, again, spouse A is awarded, let's say it is a federal tax, you got to pay the IRS, but they don't pay, the IRS will then go after spouse B because it was a joint tax filing, a joint tax.
That is correct. The IRS is not a party of your property settlement agreement. Just like, so they're not going to sign off on that. So even if you have a property settlement agreement which says spouse A is going to pay this, that doesn't sever joint liability. Now, it is evidence that you could bring in an innocent spouse request, but it's not the super strong evidence or kind of a presumption that it is on the FTB side.
Very, very interesting there. So if they go after spouse B and garnish a wages bank account or levy bank account, or even just take a post-divorce return, spouse B is going to have to go to the family court to get enforcement. There's not much that they can do at the IRS level.
That's true.
All right.
That's true.
The other issue that we see taxes coming into play in family law cases is support. A few years back, I believe it was 2018, there was a shift in the deductibility of spousal support payments. Can you explain how everything works now with I got to pay spousal support? And really quick, sometimes this is commonly referred to as alimony.
Right.
Here in the context, technically it's called spousal support. So how does that work now?
Well, this is an interesting question in that it has a long history of the taxation of what is called spousal support now. And it's gone back and forth over the decades. Now, the basic idea as codified in internal Revenue Code section 1041, is that transfers between spouses should be tax neutral, even in the context of divorce. But that rule was kind of ignored for many years because they had a overriding rule that basically said spousal support is deductible to the person who pays it and is income to the person who receives it. There was a huge amount of problems with that. Enforcement problems. You would have one person claiming the deduction, maybe they weren't paying, and you would have the receiving spouse not claiming it as income, and maybe they were receiving it. And it was very difficult for the IRS to enforce it. Also, it kind of went against the basic tax idea of neutrality between spouses. So, you're absolutely right. They changed the rule back to a more neutral rule, meaning after 2018, it's not deductible paying spousal support.
So the payor of spousal support can no longer
get a deduction.
Okay.
And quite simply, they got rid of a lot of deductions in that in that bill, and it is no longer income to the payee. Again, it's a neutral type idea. So they've, like I said, they've been back and forth. Currently, not deductible, and on the other side, not taxable income.
Do you see any changes on the horizon, or are we? Is this pretty solid for a couple years?
Too busy. To me, I think this is the better rule. This is the more simple rule. This is the much easier rule to enforce because there's nothing to enforce, and this is the better rule. And I don't see anyone jumping up and down to change it.
Okay. The other issue we see with taxes is calculation of child support. I explained earlier, child support, the way that we calculate it here in California, it's a guideline amount. The state legislature and all its wisdom a long time ago when the family code was created put together this formula. We use this computer program now.
Right.
There's various ways that income is put in,
right.
such as wages, self-employment income,
right.
Other taxable income, dividend income, investment, and so on and so on and so on. Can you explain the differences of
Sure.
each of these types of income and why it is so important to enter that the right way to make sure you actually have a good picture of what your income is?
Right. So we call it the income tax, but really there are all sorts of categories of income. And so you're talking about, a lot of it is preference on rates, and the other one is preferences on employment taxes. Okay, so let's start with the most common one, wages. Compensation, W-2 wages. That has no preference for rate, and it has no preference as far as employment tax. Wages are subject to employment taxes. Now, take something like dividends. Okay, you own stock, and it issues dividends. Okay, each year, or even interest. Let's start with dividends. It's the opposite of wages. Dividends have a preference on rates, what the tax rates, and dividends are not subject to employment taxes because you're not getting paid dividends by being an employee. Okay? Then there's a bunch of categories between those two extremes. And I've already mentioned interest. Interest doesn't have a rate preference, okay? It's ordinary income to the person, but it does have a preference as far as employment taxes. It's not subject to employment taxes.
So when we're going through all of these categories, you talk about these preferences. Essentially, they're all just looked at differently, and
yes.
different slices of those pies come out.
They're taxed differently.
Taxed differently.
Exactly. They're either taxed at a different rate. There's ordinary, and then there's preference rates for dividends and gains and that sort of thing. Or their wages that is subject to self-employment tax, or their self-employment income, meaning if you have a business, you're not an employee, but you are subject to self-employment tax because you are making money kind of as your own employee. Or they're not subject to either employment or self-employment tax.
So very important to make sure that it's understood what type of income this is, to make sure when putting into that calculator, we know how much of the piece of that pie is left to properly calculate support. Fantastic.
Exactly.
Hey, Pietro, I want to thank you again for joining me today. Remind our listeners how they can contact you if they find themselves in a tax situation.
If you want to contact us, if you have tax issues.
Not if you want, if you need.
If you
Absolutely.
need.
If you get that letter from the IRS, you contact Pietro.
All right. Our number here is 951-319-7674, or you could visit our website at IE Tax Attorney. That's Inland Empire Tax Attorney.com.
IETaxattorney.com. Hey, Pietro, also, what comes up right after 50 Scales of Gray?
Tax Talk at 7:30 a.m. on KATY.
Fantastic. So if you want to go ahead and get more information about taxes, you definitely want to go ahead and tune into that. I want to thank everybody out there who tuned in today. Remember, you can join us here every Saturday morning on KATY-FM 101.3. For more information about what we've discussed today, or to contact the Gray Legal Group, go to 50scalesofgray.com. That's 50 Scales of Gray. Gray with an E. Remember, the Gray Legal Group, because the law is not black and white. Have a great day, everybody.